Hi, Alpha Capital team. It is the end of Q1, start of Q2. So where are we? I'm calling this the Q2 345 trading heaven. We've talked about it before. A lot of markets, the indices, done their nesting just like gold, are breaking out, putting in their threes, lots of consolidation fours, and ultimate high fives. That means that the fours and the fives all sit on top of each other, and we get ever higher high rallies and stay in this quite comfortable range. I mean, it will look like things are retracing quite heavily at times. People will be jumping up and down, telling it's all over, but I think it is growth trumps everything. We've said it before from the macro hurdle. Once we start worrying about rates not coming off, that's not because inflation is going to be robustly hard. It's because growth is allowing for the fact that we can nicely survive with both happening at the same time. So that's the way we're going to go. When we talk about the kinds of data to expect in the market, there's lagging information, stuff that's looking backwards, which is kind of unemployment, GDP. Some people argue about that, but CPI, things that have happened in the past, and whether it's you can extrapolate it forward. Then you've got coincident stuff, things happening right now. Well, that's where your personal income and spending is showing up. Industrial manufacturing production, like we're going to see with the ISMs and the PMIs this week in the States. And then leading ones, that's kind of auto sales, real-time confidence, housing starts, things that confidence is there in the economy to do stuff right now. Now, the fact that we're in Q2, the consensus is that everybody is cutting rates in June. They're falling over themselves. ECB, Bank of England, UK, Switzerland have started. Excuse me, I've got itchy nose. A lot of this information is going to feel like it's coincident. We're going to be living off the data points. So that's something to be aware of. Lots of people looking at Waller's comments and Bostic with the one. We're going to show you throughout this presentation where the dot plot is. It's been extrapolated by people. They don't actually reveal who they are, but you can work out from the commentary. And then the voting members versus that. So it very much looks like there's a majority of people who want to ease the most will be the voters in come June time. So unless something seriously goes wrong, which is what Powell is effectively saying, he's buying himself the optionality either way to cut or not. As long as things don't deteriorate, he's going to have the backing to be a cutter when it comes to June. So ignore the fact that the media is all over Bostic and Waller. They are in the periphery, really. They're on the outside. Goolsbee is a big dove, but he's not voting this time. So we need to really start being aware of who's who, and we'll guide you through that as it comes along. I've got a few charts in here about seasonality, which I've gone on about for weeks. Once you get into Q2, there's some great work out there. April generally is the worst month of the year for the dollar. 2/3 of the time it goes down. Now, often it starts April reasonably robust, and then it deteriorates. Now, looking at the setup at the moment, obviously you've got Japan trying to talk down or talk up its currency. You've got the ECB looking like 4 cuts. That's causing problems for dollar weakness. Bank of England, they're suddenly coming to the fore, and Mrs. Mann, we'll talk about her, has come back to the pack. So really, it's difficult to find anybody that's standing out in terms of weakness in the short term. But you'd like to think that as confidence grows and people are looking for new homes for their investments for Q2, emerging markets have underperformed developed markets. Natural home, that will require the usual seasonal dollar sell-off. And then, stock markets have the old adage, sell in May, go away, come back on St. Ledger Day, which is in September, famous horse race. You tend to get a little bit of reversal into the month of June when it's a bit sideways, choppy, and then depending on what year you're in, we'll see. But with it being a presidential year, a lot of the time, everything gets done by the end of Q2, and then we kind of go sideways. So let's see where that is. Now, lots going on in gold, hitting all-time highs. Quite strange, thin volumes going on. We've talked about it, nesting and doing ever higher highs, but it's getting quite difficult to even get in what would look like a normal pullback. So there's something definitely going on, and it feels very much like that is all this central bank buying. It's a secular move, something that stands out over a period of time. It looks very much like central banks have decided there is a geopolitical issue going forward, lots more potential for wars and payments, and the asset ratio required. They need to hold more gold because of the debasing of currencies. China's been the huge buyer in the last year or so. They increased their holdings by 10%, 200 odd million tons, but even that's only taken them up to nearly 4.5% of their reserves. Now, historically, banks used to hold anything like 40% of their assets. The average is probably around 20%, and we'll look at some charts to see where we are. So China potentially has a long, long way to go, and in the short term, if they are trying to position so that they can go into Taiwan, they're worried about what happened to Russia with all its dollar assets frozen. I don't think price really matters. There's a massive scramble on importing gold back home by a lot of countries at the moment. I think China very happy to keep buying this higher and higher. So keep an eye on that. So it just sits with our narrative, super cycle, but you've also got massive geopolitical issues and financial issues in the background. So where are we on the CME at the moment? 63%, nearly 64% chance of easing, and the predominant amount of that is still in the one cut arena, 60 odd percent, just 2.5% expecting anything bigger. That's not really going to happen. If they go, it'll be as risk free as they can, which will be 25 bips at a time. It's only if they get behind the curve. So as I said, consensus is for June. That does mean that if things fall apart very quickly, they could well go like they did on the way up, a bunch of 50 basis points if things look like it needs it. And we've got another chart that we'll see in a bit on the fact that we're into non-farm payrolls this week on Friday, part-time work versus full-time work. Once that starts to lean towards an increase in part-time work, and we've shown you that on the increase or the decrease in hours worked, people are taking jobs but working fewer hours. That normally suggests that part-time's coming to the fore. That's normally a sign of a recessionary behaviour, or certainly a marked slowdown. And at the moment, we've got full-time rolling over and part-time jumping up. We've got jolts on Tuesday, which will hopefully back up that the quits ratio was low last time. People aren't moving for higher wages anymore, and it's very much a case of lots of jobs around to keep the books balanced. So here we are, a couple of charts on gold that's in the pack. By the end of 23, gold holdings, percentage-wise, Turkey, massive inflation problems. They're holding all their assets in gold. The United States, which gets a lot of criticism, they're here with around 70% of their holding. China is well down the pack. It's a 4%, huge amount of work to do to get that asset ratio up. A lot of criticism for America with their out-of-control debasing fiat currency, but they are the largest holder of gold, 8,000 tons, 32,000 ounces per ton, at $2,200 an ounce. That gives them around $500 million worth of gold. Obviously, the more gold gets squeezed up, the better that is for them. So it's not all forlorn. They do have some asset backing. Remember, there's always a value to assets and real estate and that sort of stuff. So it's never as perverse when it comes to the countdown, but since they came off the gold standard, and then when we came out of the 1970s agreement as well, it's been 50 odd years in the making, this issue, and it doesn't look like it's stopping anytime soon. I've mentioned the seasonality of the dollar. Some great work out there. MRCI and equity clock are things that I've used, but you can see from the graph, a little blip up at the start of April on average over 15 and 33 years. Then we get serious sell-off into May, a bounce back, and then June, proper trading range. Often Q3 is pretty negative as well before you finally get a bit of repatriation in December. It is repeated in there. And obviously over that period, now if the dollar's going down relative to the S&P could stand still and the dollar would underperform. But in general, I think you will see it doubling up of the S&P, possibly outperforming, even a bit of broadening going on. There is something I'll discuss in a minute about some strategists changing their angles slightly to try and capture just what might be, as we're expecting, a consolidation before we go higher. Just trying to be a bit clever. Then it shows you the average return. It's the second worst in April after December. December's closing up books for the year. But the important thing is, look, only goes up 35% of the time in April. That means 2/3 of the time the dollar does underperform. So, don't take that as read. It's not an outright go out and sell the dollar. Look at the trend discussed earlier. There are some issues short term with Forex leadership, but, this is a backup tool. Don't rule it out. Get your trend as your friend to start with, but, seasonality is a huge factor in the background. Make sure you're all over the drivers for that seasonality at any one time. I might as well talk about Catherine Mann here at the time. I was on the way to our latest Pips and Pipes recording, listening to her reasoning on Bloomberg for why at the last Bank of England MPC meeting she came back to neutral. And she was adamant and sounded very sensible, eminently sensible, that the market, so they only set the short-term rates. The market then decides where rates should be for risk-taking, etc. And then she reverses that and goes, but in my opinion, the market got ahead of itself and they were pricing in far too many cuts for what was likely to happen. So I was voting for a rate rise to counter that. Well, that's just absolute nonsense, isn't it? You've admitted that you think conditions of ease and you're suggesting that rate cuts is where we should be. Communicate. Tell everyone that you think that it's overdone. What you don't do is churlishly take the ball home and go, oh no, I'm going to punish those people and lose all credibility going forward. We must raise rates. Absolute fallacy. You just confuse the whole issue. I'm one of these people. There's lots of people this is serious for. Interest rates, matter to people's lives. Mortgage refinancing, business refinancing. We need these rates setting appropriately and not people playing silly games. So sort it out, love. Come on. Shocking. So where were we for the quarter? Indices generally all positive. Certainly the ones that we follow. The Nikkei up 22%. The worst performer was the FTSE, the stock of the doldrums. That struggles normally with overseas earnings. It's a dollar driver, but the dollar has recovered slightly, and that's when you've seen it pick up in the last few weeks. So it again may struggle if we do have this seasonality coming through. It might still be the bottom of the pack, but I might actually change the sideways. If it's beginning to look a little bit impulsive on the chart, we'll have a quick glance at that later. I mean, for Christ's sake, it's been 2 years of absolute apathy. So generally, indices are all at or close to all-time highs since that October 22 low. Even the FTSE's up 10% from that period. It's been in a sideways range. Again, Nikkei outperforming over the last 2 years, up 36%. The IBEX in Spain, 26%. So despite all this jumping up and down of markets bubbling up, they're still only in the States 10-11% ahead of where we were at those lows. Sorry, rewind that. They were 10% above the all-time highs at the end of 21, early 22. So, it is a good performance. These are breakout highs to new performance from what were previous good breakouts. So, it's been good. It might be time that we have a pause, but it's again, there's a great chart from Ed Yardini, and I've seen it pushed around by Julian Trimmer at Fido as well. We are pretty much mid-bull cycle run at the moment. So there's lots and lots more upside to come. It's a definite buy the dip scheme unless something massively changes. I mentioned that some people are talking about tweaking their tech positioning, underweight hardware but staying long software and semis, suggesting that defensives might outperform if rates do come off. But at the moment, the biggest danger is that the rates stay higher, and in that case, the larger tech growth companies will probably continued to outperform after a little bit of a likely wobble. Forex has had pretty tight ranges. US dollar, Japanese yen has been the big outperformer for the quarter, 6.5%. But as their finance ministry have said, that doesn't make sense versus the fundamentals. It's all been very speculative. And we'll look at a chart in a moment, which suggests why it's been difficult. But now that they are suggesting some form of intervention, might not be direct, the yen is set to potentially outperform short term. So yeah, there you go. The red line is the current recovery for the S&P 500, 377 days from its actual low now, and that's up 45%. Some of these, there's only a few actually with a lower recovery than that. So on the yen, speculators had a go at it. There was no longer a negative interest rate policy. There's no longer yield curve control. So that meant that all the issues would have to appear in the yen itself. And, with them not signaling any more rate rises, it's a bit of an open goal for speculators to have a go. And there is a little rule, G7 intervention rules suggest that not only does your currency need to be an extreme, but it needs to be volatile. Well, look at this chart, 1 month implied volatility on the dollar yen. Look, big downtrend and almost at lows. The last intervention was over here in this period in 22. They're going to find it hard to suggest that it's volatility causing the problem. So they do need to find ways of talking this market up, and they've started trying to do that. Bond market's not really showing any charts on that, but one thing to get your head around is the fact that high yield, we mentioned it the other week, is at record low spreads relative to risk-free treasuries. Is that a sign of a market at the top, or is it just confidence in the fact that there aren't issues in creditworthiness out there? I would suggest it is the latter. And what you're going to see is as rates are anticipated to fall, people are moving down the yield curve into corporate bonds, and they're literally looking for a home. So issuance, despite looking like it's a problem at both the treasury level and at the company level, I've got a feeling it's going to be swallowed up nicely. People are hunting yield for the rest of this year. Now, I talked earlier about leading indicators. Agricultural commodities tend to be. This is a great chart that Crescat Capital, this Octavia Costa, very cute guy. You can find him on LinkedIn a lot of the time. We've seen what's happening with cocoa, etc. at the minute. So this combination of soft commodities through the roof, and that leads CPI by 3 months. So we may well get into that situation in June where everything's looking okay, but there might be a shock to the system. Will that stop the Fed from doing something? They may well cut rates. It all depends on where the rents are and whether this hits profit margins as opposed to actually causing gate inflation and consumer purchase price inflation. Oil I've tweaked a little bit on the chart. We hit that $83. The fundamentals keep being screamed around. The tech chart suggests it might just have a little bit more juice into it, up to about 86, but it's still artificial tension. I'm looking to put a short on in that at some point. Not overly convinced. So I mentioned the dot plot earlier. Powell came through. PCE was in line on Friday. No real issues there, and as he intimated, but he's on the lookout both ways. There's no bias. They're being sensible. I don't know why the financial media is obsessed with just going, it's end of the world inflation, there can't be any rate cuts. It's still on a knife edge, can go either way, and he's very sensibly commenting that way. And I mentioned, part-time, full-time. You got full-time coming down from a high here. You got part-time coming off lows. They're coming towards each other. It's normally where the recessionary periods appear. This is the estimated dot plot by Deutsche Bank, where people are now. If you're in red, you're a voter. So the people who are stand still, you've got Bowman and Bostich, but Kashkari and Schmidt won't be voting. The ones that are expecting a couple of cuts, there it's still 3-2. in favour of voters. And then when it comes down here to the ones expecting large amounts of cuts, it is 6-3 in favour of people who are voting. So when it comes to it, what we got? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So of the 12, there's only a couple that are talking about 1 or 2 rate cuts. It's very much, as long as data doesn't change, they are coming down. Clocks have gone back as of tonight on the Saturday. So when the Monday session starts, data and markets will be back in line. Look out for German CPI. France and Italy both surprised to the downside, and with it being shut on Friday, the Forex didn't really show any issues. There might be some fallout on Monday as we play catch up. Very much looks like the dollar needs one more high, the euro another low. We may well get this, and if German CPI follows in, that will set us up for Wednesday's full European CPI to be soft. We talked about jolts. I think that'll be all right. UK money supply, mortgage approvals, and a PMI, the S&P global PMI. On Monday, we've got the market PMI at 245, followed by ISM at 3. So far, all the read-throughs have suggested strong new orders and no price issues. Hopefully that comes through again. ISM services is on Wednesday. That should be flat again. Look out for the crude oil and an OPEC meeting on Wednesday. Might be a little bit of volatility there. More trade data for the US. That's sort of coincident data that we mentioned earlier. Friday, Euro construction and industrial data. So those are very much where are we? And we know that the manufacturing side of particularly Germany and France has been poor. Any kind of uptick would be taken well. And it's non-farm payroll. Pretty much a good chance that is calmer. But, are we with all of these things, CPI, non-farm payrolls, are we actually leading up to there being a big shock to the downside rather than the upside? The underlying trends that are being ignored by the financial media are slightly negative. The fact that you've got unemployment soft and initial claims quite soft is masking over what might be going on under the hood, i.e. the part-time, the earnings rates and rents are about to collapse. If real market prices are anything to go by for the last 6 months. Not a lot so far on the talking heads. Royal Bank of Australia Assistant Governor will be out on Monday. The RBA meetings, they will be hawkish. The commentary afterwards was pretty much, we're miles away from a rate cut. Mester and Daly on Tuesday, Mester again on Thursday. So let's have a look at a few charts. As I said, the dollar last week, I've not really changed many of these charts. It still looks like we are going to put in another little blip to get the spot 618 in to finish off this minor wave 2, or are we just halfway between a WX and Y to make the two up at equal legs, 106.77, 717, sorry. I don't really want it to go much further than that. Highly likely 105 to 5.5 is probably the real stopping point, and it may just come earlier in the week with just a blip to a new high. Let's hope so, at least. A number of times we came on chat, we've adjusted the gold chart a couple of times. Again, we're pretty sure that we're in a fourth wave. The MACD outperformed here for what should be a third wave, and you'd expect to have a lower MACD for a fifth wave. So the fact we've put in a new high suggests that could be. The original idea was that we had this fourth wave finishing on the previous Friday, the 22nd, and then we could very much have been putting in an ending diagonal type wishy-washy three-wave move, fifth wave here, and it would be in line with the MACD, as we said. Or it could equally be that we've had a W, we're having an X, and then we're going to have this Y down to complete the 4, back around that original 2150 equal legs kind of idea before we're back into our Q2, 3, 4, 5 idea on gold, squeezing ever higher, higher lows and higher highs. It's that's the way I'd go for, but it certainly looks like that was a very thin. Look at that spike after hours on Friday. Shocking, really. Everyone caught out, super thin. it's just set up for some kind of pullback, isn't it? Will that be enough? That dollar putting in the final high, is that enough just to get us into proper consolidation before we can set sail again into that non-farm payrolls probably at the end of the week? CLI, like I said, we could do lots of things with this. We had that divergence. Similarly, if we're in this little connector here, it's pretty no real divergence there, and we could just be putting in what now could be a connector, and we're doing another equal legs part to make the Y finish up here at the equal legs 86.18, maybe 86.74, 1.382. That would maybe be a blowout, exuberant high in crude oil, WT1. But, it's just the fact that it's put in an incremental new high there. Let's not fight that. That is good discipline to suggest it could go further. I'm looking to try and short again closer to this equal legs if we get the chance. But keep an eye out. That American supply is really at the fore. And any signs of economic slowdown, this thing's going to get smasherooed. So be very, very wary about buying into the financial media, going to the moon nonsense. FTSE again, still got it set up as an AB, potential C down, but this pattern here from what was the X low, that could easily be an ABC two wave. We had that one at the previous high, and this is starting to have the appearance of, at the very least, a bunch of potentially a leading diagonal to start getting lots more impulse to the upside and dragging consolidation. So I don't rule out the fact that this could easily be a one wave as part of a whole new 5 waves to top if the FTSE suddenly decides to play catch up, having been the laggard. Nasdaq again very much in that 3-4-5 consolidation nesting we've talked about for a week. US data flip-flop for the first week of Q2. Has this done enough to put in a consolidation 4 already? Don't rule out a little dollar-inspired, data-inspired blip back down here to that. We're in the range of the previous 4th wave. The bottom of the trend channel is down here at 17,800. The actual uptrend channel, 18,100. We're only 1% above that with the late sell-off on Thursday. So anywhere between here and 17.8, then it's off again into this 3-4 ever higher consolidations. Keep an eye on that. I think that's just going to go and go. It's the perfect place to be hidden. The German powerhouse again. If anything, there's a good chance that the ECB goes even earlier than June, despite all this wage data nonsense. If their data continues to deteriorate, Germany has to have some kind of fillip. It's already discounting nicely ahead. German CPI this week and in the Eurozone could just be enough to put us into to finish off this first 3rd wave, and then we're into the 4-5s consolidation higher. Still grinding at that channel. So very much keep an eye on that and be careful of fighting the DAX. Said it every week. And it just surprises me every week just how shallow the pullbacks have been. And finally, just to reiterate on the dollar, it very much looks like we're in a 2-wave consolidation for EU, the euro, US dollar. Over here, the previous low before we put that one in is around, we've put the blue line, 106,950. If the sell-off continues to go through that, then we've got a whole new situation. That means that the one was probably an extension to that original sell-off. So it'll have been a double correction. I think either way, we're nearing the bottom. Every chance that 107 holds. Just look out for early weakness, basically based on that. Those CPI reads probably from last week and the German and Eurozone ones this week. It's going to be very nervous. And as I keep saying, it looks like the euro should outperform medium term against the dollar, but near term we've got the likelihood they're doing more rate cuts and their data's deteriorating a bit quicker than everyone else. So just watch out for that, particularly in the first couple of weeks of April. And again, that might be the thing that in that seasonality just shows you the early April blip up. No real stock earnings out next week. Is there anything else that happened? 152 seems to be the yen area that they're definitely going to defend, and it's where a lot of the under-overs were supposed to be. So that is where people have got option positions that they need them to be either side of that to make money. As the hedges started pressuring, the speculators pressuring the dollar yen, the swap rates went out to about minus 60 bips. US dollar yen, 3-month swaps, I think it was. But since that intervention talk, they bounced back to minus 20. PCE was all bang in line. The Dallas PCE, after everyone had stopped watching that, confirmed the downtrend at 3.4 versus 5.7 previously. Talking heads from last week, not a lot really to change anything. The Bank of Japan minutes, we knew about that. Lagarde said nothing. Goolsby, he maintains 3. I've talked about Mann. Lisa Cook, Fed governor, said balance of risks better, but needed to be cautious as it's still bumpy. Carolyn Rogers moaned about the Canadian lack of productivity. That's the real reason why they're not cutting rates, because they've been left behind by the US and quite a lot of the other G7. So they need to really work on that and try and temper wage growth until they see signs of productivity. When the Bank of Japan were talking, it was Tamura that they sent out, and he's the most hawkish. So it was like sending out the A team to talk rates up. He did a good job. We know about Waller and Powell. No need to rush. Nothing to hear, nothing to see. Remember, most of Europe is still closed on Monday. The commodities come back. The dollar comes back. Gold comes back, doesn't it? That'll please a lot of people on the alpha community. Some good winners of late. So it's a big week for PMIs and non-farm payroll in the States. So I think that's really a wrap. We're into Q2. Look out for those 3, 4, 5s. Play the ranges. It should be beautiful trading ranges. No need to do more than trade those trend lines. Get the parallel trend lines onto the wave extremes, and we should be off and running. As always, be careful out there. Please digest this. Come back with questions. Come on the chat. We're getting a lot more interaction. Hopefully you get an invite or you make yourself available to come to the seminar, which we're going to do in April or May. And we'll be starting the series of Whiteboard Wednesday videos going forward. Also, Mondays and Fridays will be live shows. I'm away this week until Thursday. But as of Friday, probably around non-farm payrolls, we will do a live show where you can ask lots of questions about the data and where we are. So look forward to hearing from you, and good luck.